Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this market recap dated Tuesday, the 1st of November 2016. A very important recap as it looks as though the Dow Jones and the S&P 500 in particular are materially retesting that macro support and also our trigger on those two associated markets. On the Dow, 17,970 is that area. We haven't been able to close and confirm or at least push below that trigger. But as at the close on Tuesday and during the intraday trading of Tuesday, we're definitely starting to float around this level. As you can see, since early September, the markets have really stagnated. This is just the chart of the Dow Jones Industrial Average on the daily time frame. And we've been in a really tight trading zone between really, a tight area of resistance and support. Definitively, we're still in that trading zone, but it looks as though we're starting to see, again, key inflection points start to break down. If I go into the Bollinger Bands for you, you can see just how tight these are. In recent time, I haven't seen Bollinger Bands, or at least a Bollinger Band squeeze on a market indice as tight as what I'm seeing on the Dow Jones Industrial Average. What that is telling us is that volatility is low and that we are building for a big breakout. That breakout, however, should be approached neutrally, and that's how we've been approaching it over the past couple of weeks as it continues to build, as the pressure continues to build, and we know, of course, that a big move is on its way. It looks as though, as at the close on Tuesday, that it is going to be to the downside. The Dow Jones Industrial Average, much like the S&P and the NASDAQ, is somewhat late to the party, because when I start to bring up the Russell 2000, which again is a broader sort of outlook, recapping, I guess, 2,000 smaller cap companies traded publicly, you can see that the Russell 2000 has already broken that associated level. 1,195 is that area on the Russell 2000. On top of that, we've broken this intermediate trend line, which has established itself for this bull market advance since those February lows in the beginning of 2016. So as you can see on my screen, we have definitively broken this blue upper trend line. And with this week, we're seeing a continuation to the downside. We saw some very ominous candlesticks last week. It was a very bad week for the Russell. Today, you can see again on larger volume, sell-side volume, we're down another 13 points on the Russell 2000. So it's telling us, in a sense, that market breadth is very, very weak. On top of that, if I zoom back out and go out to the weekly chart, I speak about this a lot, referencing these markets up and around these all-time highs. You can see these three levels of decelerating fan lines, 1, 2, and 3. What makes this even more interesting is that when we project that third fan line out, and I want you to pay attention to this particular pivot point down here. This was the low of the GFC. We've extended it based off these retracement points. And if you follow the red line, you can see that going into 2016 or very late, pardon me, let me just bring up the right chart again. Very late 2015, we started to break down below that level. And this is the breakdown, which is very, very important when talking about terminal trend reversals. Since then, if you've been paying attention to the Russell, much like the other broader markets, they have been positive, or since those lows, they have been rather bullish. What this looks like on the Russell 2000 is that we're simply coming back up to that third decelerating fan line, which was the last gasp effort of the primary bullish trend, and successfully retested old support as new resistance. We've been walking this band. If I go back into the candlesticks, this is the same red line since 2009, and connecting those lows all the way through to the current juncture. It looks as though we have formally reversed off from this very important resistance area, and again, we're starting to crack key areas of support on the Russell. It also looks like we have some form of a short-term double top over here taking place in the right direction. If we pay attention to the exponential moving averages, see how we're pushing away, and the three exponential moving averages are all aligned very negatively or bearishly, with the 10 below the 20 and the 20 below the 50. These are all telltale signals that we're starting to reverse. So pay attention to this. The Russell is relatively oversold. That's okay. We can remain like that, but be open, of course, to some short-term bounces back up to retest those key areas of support. Often what happens is when you get such a very important structural breakdown, you will get the inevitable bounce back up. It'll flake out, or at least it'll whipsaw. People who've positioned themselves in the correct direction initially, but short-term prices will correct. They will retest that pivot point, and then you'll see the ultimate sort of conclusion in terms of price momentum and direction, where it continues to move in the first thought downward direction. A very important message being sent by the Russell 2000. It is ahead and it is leading many of the other equity markets. If I go to the Dow Jones Transportational Average, pay attention to this chart also. We've been stuck moving sideways since March 2016. In fact, we have more or less closed where we were towards mid to late March 2016. We have identified that this is a very critical, very crucial pivot point here around that 8,000 area. We've had this set up very neutrally as well. 8,177 on the upside and 7,861 on the downside. Much like the other three markets, when we talk about trend breakouts, so as you know, the Dow, the S&P, and the Nasdaq, they have been sitting up very close to relative all-time highs. They did break out technically in July, but since that breakout, some of our trend following indicators that we look at in terms of the ADX and also the CCI have been warning us that we're looking at false breakouts on the macro scale. And I'll quickly touch on that when we go back to the S&P and the Nasdaq. But also when we compare this to the Dow Jones Transportational Average, let me do this for you. Since we've been moving sideways since that specific date, the CCI isn't liking the move, nor is the ADX, which is very interesting. We're failing to overcome 8,177, and it looks as though we're stagnating and about to turn down. Remain, or at least a big reminder, at least on the Transportational Average, is to remain neutral on this market. The Russell 2000 is relatively weak or exceptionally weak at this point. The three other key equity markets or indices which we follow, the S&P, the Dow, and the Nasdaq, are all very ominous in terms of potential downside material sort of losses which are on the near or short-term horizon. But the Transportational Average is still sitting fairly neutral at that pivot point. Once one of these pivot points cracks or one of these triggers cracks, either above or below, and we get a close and a continuation again above or below, we should see the Transportational Average work in conjunction with the Russell, and that should also, when we talk about intermarket relationships and also Dow theory, between the industrial average and also the Transportational Average, we should see the industrial average move in conjunction again with the Transportational Average. So pay attention to this. This is a key chart. However, it is holding up much better than some other counterpart markets which we're about to look at. Here is the S&P 500, and again, going back to that discussion, dating back to the breakout in July 2016. A lot of people were very excited on that breakout, but have a look at the CCI. The CCI lets us know when we start pushing above 100 on good volume and the ADX turns out that the trend is real, the trend is sustainable, the trend is legitimate. Well, look what's happened since the end of August 2016, so no later than a month. Right, it started to turn down. We started to see some gaps in the market. We started to see some long day Morobozu candlesticks, a number of reversal candlesticks, and it looks as though we're sort of seeing a rounding top, a very slow rounding top, but also we've got a series of lower highs once again. The good news for the bulls is, however, okay, and I'm talking more so on the minor level and also the intermediate level, is that again, since that 2009 uptrend, this picture looks different to that of the Russell 2000, the one that I just showed you before. We've got our three decelerating fan lines over here. The third decelerating fan line, however, is still below price. This is, pardon me, the extension of that level. Let me zoom out and show you this. You see this line coming up through here? This is still the extension of that third decelerating fan line. So the S&P 500 is still technically in a macro bullish uptrend. So a good target, if this is a legitimate breakdown from 2,112, again, I'd like to see it close and a continuation below this level, is to bring us down in terms of price to 2,000 on the S&P 500. That would be a fairly decent retracement that would shake a lot of things out. Then we'd have to assess what is going on down at these levels and then follow very closely with, of course, the associated bounce, which will soon follow. If that bounce fails to produce a higher high, then look out, because structurally this market is very weak in terms of price action and also a lot of chart patterns which are showing up across the board on these equity markets. So I'm looking for, if this is proven to be true, a sell-off down to around 2,000, and then we will again analyze and follow very closely with the associated bounce which will follow if in fact this primary bullish uptrend, the third decelerating fan line, holds. All right, so I'm going through a little bit of stuff in this market update, but it's very important because I don't think the majority of people understand just what's at stake at these current levels. The Dow Jones Industrial Average, the same discussion. If I go out to the weekly chart, this is again the projection from the 2009 low. We've got the four decelerating fan lines here. This is a little bit of a rare occurrence in terms of technical analysis. Generally, once you break the third decelerating fan line, you're moving sideways, or at least you're coming back up to retest that breakdown. We've done that in many instances with these highs since the breakout in July 2016, but since then, again, that successful back test, and we're starting to roll over. If the Dow cracks this level, minimum target around 17,250, even as low as 17,000, that may happen very, very quickly. We're seeing all of the signs which we saw prior to the sell-off at the beginning of 2016, and it looks as though this may be again setting up more or less right now as I produce this recording for you. The Nasdaq, which has been relatively the strongest of all of the markets I've recapped, against the Dow, the S&P, the Russell, and also the transportational average, it is still holding up around these levels. It is still holding above 5,100, but this topping pattern, which is happening right now with all of these gaps and spinning tops and bearish candlesticks on pretty decent volume, is starting to paint a different picture. On top of that, we have definitively closed below the 50, and the 10 is just crossing the 50 as well. These are all warning signs that the trend, even if it is short term, is starting to change. We're holding above the 100 at the moment. We are somewhat oversold on the oscillators. That's all right though. But what you want to be paying attention to is macro support, macro resistance, and that is more or less where we're trading at across the board on these markets. So just to recap what I've spoken about over the past 10 to 15 minutes is that, look, markets are at macro support. Expect volatility to continue until we get a definitive Bollinger Band break, all right, a volatility outbreak. That may happen this week. It may sort of hold on. We may see some sort of inside day volatility where we get, potentially one white soldier or a large white Marubozu candlestick, which pushes us back into the Bollinger Bands. That may happen as we move into the election, November 8th. There's a lot of uncertainty in the market. It appears that, again, markets are stagnant. They are unclear. They are, bifurcated, confused. They're very uncertain about the future. That's why price is stagnating, and until we've got a clearer direction, I think politically in the US, there's a good chance that this breakdown or this material breakdown, a correction in the markets, won't actually happen until next week. However, you don't want to miss out if in fact it does happen this week. That's why we use contingent triggers, all right, based on price, which we use when the market is closed to take all of our emotions out of the trade. So I hope this has helped you. I hope you've learned a little bit from this video and you've got a better understanding, a clearer understanding of what's going on in the market and what to expect if certain key levels are broke. Of course, if the opposite happens, then we'll be looking at the big long-term trend correction. But at the moment, again, according to some very important, some very powerful indicators like the CCI and the ADX, none of these triggers, none of these indicators are with the bullish advancement. They're all showing material weakness. They're all showing weakness in terms of breadth as well, and the majority of stocks again are well and truly below their 50 exponential moving average. I think that statistic again just dropped to under 30%. So under 30% of stocks traded on the S&P 500 are actually above their 50 exponential moving average, which is telling us a lot in terms of the short-term trend, but also what may be happening in terms of, in context of the larger picture with this potential terminal reversal pattern, which a lot of people are championing for. I'm not so much championing for it. It just looks as though that this market is exhausted. It's overrun its course, and it's just looking for, again, some form of a natural correction, which will, again, revalue asset prices to a more fundamental fair value to what they are currently valued at the moment. So think about that as we move into trading on Wednesday the 2nd. If you have any questions, email me success at pivotpoint-trading.com. Other than that, everyone have a fantastic evening. I'll be back on the airways if we do see some very important price action continue. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.